resilient investments. Some examples of competitive modes include brand loyalty. Companies with a strong recognizable brand often enjoy customer loyalty, which can translate into repeat business and pricing power. Examples include Apple, Coca-Cola, and Nike. Patents and intellectual property. Companies that hold patents or possess unique intellectual property can protect their products or services from being copied or replicated by competitors. This protection can lead to a sustained competitive advantage. Examples include pharmaceutical companies with patented drugs or tech companies with proprietary software. Network effects. Some businesses benefit from network effects, wherein the value of their product or service increases as more people use it. This creates a self-reinforcing cycle that can be challenging for competitors to break. Examples include social media platforms like Facebook and online marketplaces like Amazon. Economies of scale. Companies that can produce goods or services at a lower cost per unit due to their size and scale have a cost advantage over smaller competitors. This advantage allows them to generate higher profits. Investing in companies with a good management team. Another cornerstone of Warren Buffett's value investing philosophy is investing in companies with a strong, competent management team. The rationale behind this is that a company's long-term success is heavily influenced by the decisions made by its leadership. As a shareholder, you want to ensure that the management team is committed to protecting your interests and driving the company toward growth and profitability. The third tenet of Warren Buffett's value investing strategy is the focus on long-term investing. Unlike short-term traders who buy and sell stocks frequently, hoping to capitalize on short-term market fluctuations, Buffett believes in investing in fundamentally sound companies and holding on to their stocks for an extended period. This approach allows investors to benefit from the compounded growth of their investments over time, ultimately leading to potentially greater returns. Warren Buffett's long-term investment strategy is based on the idea that well-managed, undervalued companies with strong competitive advantages will eventually realize their full potential, leading to increased stock prices over time. By holding on to these investments for several years or even decades, investors can ride out short-term market volatility and benefit from the company's growth and success. However, long-term investing requires a significant degree of patience and resources. Investors must be prepared to commit their capital for extended periods, potentially forgoing other investment opportunities in the meantime. Additionally, since the strategy relies on identifying undervalued companies with strong growth potential, investors must be willing to dedicate the time and effort required for thorough research and analysis. Despite these challenges, long-term investing can offer several advantages over short-term trading. Firstly, long-term investors are generally less affected by short-term market fluctuations, allowing them to make more rational decisions and avoid the emotional pitfalls that can plague short-term traders. Secondly, long-term investing typically incurs lower transaction costs and tax liabilities, as investors hold on to their stocks for longer periods and trade less frequently. Investing during market panics. One of the hallmarks of Warren Buffett's investment approach is his ability to identify and capitalize on opportunities during market panics or downturns. When markets are in turmoil, many investors may panic and sell their holdings, leading to a general decline in stock prices. However, savvy value investors like Buffett recognize that such periods can present unique buying opportunities, as fundamentally strong companies may become undervalued due to widespread market pessimism. However, there are challenges associated with investing during market panics. One of the primary difficulties is identifying which companies are resilient enough to weather the storm and rebound once the market recovers. This requires a deep understanding of the company's financial health, competitive position, and industry dynamics, as well as the ability to distinguish between temporary setbacks and more severe long-lasting issues. A notable example of this investment approach in action is the market crash caused by the pandemic. While many businesses faced significant challenges and some even went bankrupt, others proved to be more resilient and managed to recover and thrive once the crisis began to subside. Investors who were able to identify and invest in these resilient companies during the market panic would have likely seen substantial gains as the market recovered. Accept that you will make mistakes. Even Warren Buffett is not immune to making mistakes. The key to long-term success in investing lies not in avoiding errors altogether, but in learning from them and incorporating those lessons into future investment decisions. Warren Buffett has been candid about some of the missteps he has made throughout his illustrious career. For example, he has referred to his investment in Berkshire Hathaway, a textile company, as the dumbest stock he ever bought. He acquired a controlling interest in the company out of spite after a disagreement with its management. This impulsive decision cost him an estimated $200 billion in the long run, as the capital could have been deployed more effectively elsewhere. Another notable mistake Buffett made was his investment in Dexter Shuko, which he purchased for $433 million using Berkshire Hathaway shares. Unfortunately, Dexter Shuko did not perform well, and the shares used to purchase the company eventually rose in value to $5.7 billion. Additionally, Buffett failed to sell his stake in Tesco before the company revealed that it had overstated its profits, leading to a significant drop in its stock price. From these experiences, smaller investors can learn several valuable lessons. First and foremost, it is crucial to approach investing with a rational and analytical mindset, avoiding emotionally driven decisions. Additionally, investors should always be prepared for the possibility of making mistakes and should incorporate risk management strategies into their investment approach. This can involve diversifying investments across various sectors and asset classes, as well as setting stop-loss orders to limit potential losses. It is essential for investors to remain humble and willing to learn from their errors. Just as Warren Buffett has been open about his mistakes and has strayed to learn from them, smaller investors should adopt a similar attitude. By acknowledging and analyzing past errors, investors can identify patterns or weaknesses in their decision-making process and work to improve them over time. This continuous learning and self-reflection can contribute to long-term investment success. Finally, it is crucial for investors to recognize the limits of their knowledge and expertise. Warren Buffett has often emphasized the importance of staying within one's circle of competence when making investment decisions. This means focusing on industries and companies that an investor genuinely understands and avoiding investments based on speculation or hype. By staying within their circle of competence, investors can make more informed decisions and avoid potential pitfalls. As aspiring investors, we can draw valuable lessons from Warren Buffett's experiences and approach to investing. By adopting a disciplined long-term perspective and focusing on the fundamentals of the companies we invest in, we can significantly improve our chances of success in the market. Embracing the importance of learning from our mistakes and managing risk is also essential, as even the most accomplished investors like Buffett have faced setbacks along their investment journey. Thank you for watching the video. If you like the video, please subscribe to the Finance Bowl for more money and investing tips. Until next time.